People want to say, hey, you should hodl your Bitcoin. We already do that with real estate. Their time horizon on that investment is measured in decades. So what we're doing here is allowing Bitcoin to get the same kind of natural time horizon that you're already establishing with real estate.
Today's guests are Matt Luongo and Nathan McCauley. Matt is the founder of Thesis and co-founder of Mezzo. Nathan is the co-founder and CEO of Anchorage Digital. Together, they explain how institutions borrow against Bitcoin, why Bitcoin collateral is going mainstream, and how on-chain lending is becoming a core part of modern finance.
Anything where it's like, oh yeah, this is a good investment. Your parents told you, oh, we've done this for generations. Those are things that the monetary premium is going to be stripped by Bitcoin. You know, a lot of people probably wouldn't believe it, but when you say, well, Bitcoin could fix housing prices, and then in the end game, they won't believe it when you can say, well, Bitcoin means a world with less war.
Matt, Nathan, welcome on.
Thanks for having us, Jackie.
Great to be here. Thanks for having us.
It's going to be a fun one for sure. So last month, your two companies announced a strategic collaboration, essentially allowing Mezzo to offer borrowing through its stablecoin and Bitcoin yield opportunities. And then Anchorage would serve as its institutional grade path for asset holders. I kind of wanted to lay that land there so people understand the context of, you know, the podcast and having you guys together. But I guess, what do you kind of see as the big unlock on this front? Why does this really matter?
You have this huge split between Bitcoin and the rest of crypto, where obviously institutions understand Bitcoin. Other assets are, you know, to quote Sailor, there is no number two, right? Mm-hmm. But a lot of the tech has been focused around these other chains and other assets. So I think there's an opportunity with offerings like Anchorage to make like Bitcoin DeFi actually accessible to institutional investors and to kind of get the custody and the regulatory stuff out of the way so we can focus on benefits.
Nathan, what about for you?
Yeah, the way I look at this is that institutional investors particularly like Bitcoin more and more. Bitcoin is getting more and more popular among institutional investors, whether you're talking about ETFs, digital asset treasuries, or others just looking at Bitcoin potentially as inflation hedge or the long-term asset they want to hold. And for a whole host of reasons, some regulatory, where they literally have to use a third-party custodian, some operational, where they say, hey, we like the idea of self-custody, but it just doesn't work organizationally for us. They choose to use custodians. And when they choose to use custodians, they don't want to get cut off from some of the opportunities that are available to them. It is very common for institutions to say, hey, I want to borrow against the asset base that I have. I want to be able to utilize the assets available as raw material to be used for, say, borrowing or other kinds of things like that. And that's why we're so excited about the integration with Mezzo, because it allows that from within qualified custody, from within Anchorage Digital Bank. They're able to actually borrow from that setup.
I mean, the crypto markets in general are cyclical and regulatory sentiment is globally pretty fluid. So I know you two talked about kind of the institutional interest, right? But why do you kind of see right now as the time to launch this institutional stack? Like, what are the macro or industry signals that kind of showed you the timing today is the best time for something like this?
What I'm the most excited about, which was a surprise to me because I feel like I'm not as deep in with some of these regulators as some folks in the space, but was the Freddie and Fannie news, seeing that they are looking at, okay, what's our guidance going to be for crypto balances on exchanges to count toward like actually like your ability to borrow for a mortgage. So that's huge, right? That's a long shot from, you know, people can use DeFi to buy their homes. So I think, you know, we're seeing kind of like regulated finance and then DeFi move toward each other. And I'm really excited for that.
Oh, no, I was just gonna double down on what Matt was saying. I think the Fannie and Freddie news is interesting in a couple of dimensions. I think it's very natural for people to look at mortgages and understand a mortgage is where you take your house as collateral and borrow against that. And I'm increasingly seeing that people want to do that exact same thing with Bitcoin. They want to be able to effectively mortgage their Bitcoin in order to utilize the value there in order to get some additional financing or cash to be able to do other things. And so allowing institutions to do that, I think, makes all the sense in the world. And then Fannie and Freddie also saying like, hey, not only are we going to say that houses can be collateral for the loans that we give out, but also the Bitcoin can be eligible collateral there, I think it's a huge testament to how far Bitcoin has come.
Do you see a lot more people using Bitcoin as collateral, like to mortgage their homes and things like that? Or because I've heard this before in the past, right? And I've heard a few stories, but has it increased in your opinion?
On a whole host of different use cases, people are doing it. I think it's becoming more and more popular with, say, second homes or second mortgages, investment properties, because thus far it hasn't been Fannie and Freddie eligible to have it in your primary and your primary mortgage. And so I think the unlock for Fannie and Freddie is actually going to allow it to become more popular because of that eligibility criteria. Right now, most mortgages ultimately end up at Fannie and Freddie, and so all of the underwriting requirements that you're subject to there are basically set by Fannie and Freddie, and your local bank is just like kind of the executor of that. And so I think like being able to allow Bitcoin will allow a lot more of that to get opened up into the ecosystem.
It's almost a cheat getting asked this question because like it's actually how I've financed my home. So I've been kind of going from friend to friend with Bitcoin, being like, hey, like, are you settling down? Do you want to buy a house? Like, are you just going to like, what are you going to do? You're going to retire and like, just like swim through your stacks and stacks of UTXOs? No, you know? And so I think, but you know, for someone like me, I'm an early adopter, and this required getting to know my lender, getting to know all of the rules, doing a whole bunch in advance. Like typically if you want your mortgage to be resaleable and to be a typical mortgage, you have to do everything in a very particular way and not accidentally get bumped out. So I think we're going to see more, but people need help and they need clarity. Because even before Freddie and Fannie are done, right, there's actually a way to do this now where you take an asset-backed loan with your Bitcoin as the asset, and then you use that cash. But it's tricky. So we're actually working on guides for folks to do that now with Mezzo who want to like get in early. And it's only going to become easier.
When you think about institutional interest and, you know, the growth of Bitcoin as an asset, how do you think people want to access and leverage their capital today? Is it in the form of what we just talked about, or is it something completely separate? How would you guys kind of categorize that?
Yeah, so I think we're seeing a whole variety of things. I think people are looking at what is roughly emerging as the BTC-Fi ecosystem and starting to say, hey, we want to participate in the opportunities that are available there. And so as this ecosystem is getting built out, you see kind of a natural set of services that are coming in. I think Mezzo is one that really makes sense to a lot of people. The tie-in between collateralizing Bitcoin, getting loaned for that, and then the stablecoin portion of it, I think is pretty natural. Others are looking at things like, say, hey, is there an opportunity for Bitcoin staking? Can I earn a little bit of yield on the assets? And so those two sides of the coin of, hey, can I borrow against it or can I earn against it, are, I think, the natural places that people start, and then start to look at, hey, what are the options available to me? Do I feel good about them? And is it safe and easy for me to participate in that ecosystem?
Yeah, I'm seeing the same on my side. I think there's this really interesting dynamic right now where we're seeing Bitcoin treasury companies and we're seeing a bit of a reckoning, right? Now, a lot of the haters thought the reckoning would look like this incredible leverage unwind, and I don't expect that's how this goes. What's happening instead is you're seeing compression, right? You're seeing, okay, well, look, we thought you could earn more Bitcoin better than we could at home. We thought that was the goal with these digital asset treasury companies. And so now they're like, okay, well, we've all finished our de-SPACs, we've all finished our capitalization. How can we actually deliver on that? So I think that's the other angle, right? And anytime you think, well, someone wants to earn on their Bitcoin, the way that I like to look at it is, well, there's only one native yield on Bitcoin, right? It's not Ethereum, it's not Solana, there's not emissions. The native yield is lending. We've done it forever in the space. So I think that's kind of the benefit, is when people want to earn yield. On the flip side, lending is just a tried and true way to drive that.
What would you say is then one misconception about Bitcoin, stablecoins, or institutional adoption that you wish people understood correctly?
So I hear this one a lot. Oh, well, but Bitcoin can't do that. And a lot of the time this is from people who have gotten involved in the space through other chains and other ecosystems. no, Bitcoin can do anything all these other chains can do. Um, and I think, we have this opportunity where institutions understand the economic story behind Bitcoin better than these other assets. So let's show them that the tech can do the same thing as well.
I know in the press release it mentioned that this is kind of setting a new standard for Bitcoin finance. So would you kind of see this as defining that new standard, so to speak?
I mean, I think Anchorage by itself is a very, very high standard and a very high bar. But yeah, I do think that the Bitcoin holders should be able to do everything via self-custody or via their existing QC. And that's not been the experience so far. It's been you have to kind of choose one or the other. So that's what we're landing here.
I think when you look at kind of the combination of things that come together, I think the standard is the transparency that comes from the setup with Mezzo. People within crypto, the standard is transparency. Everything's on the blockchain. You can see everything. Transparent collateralization mechanisms, transparent lending mechanisms, no discretionary yield, no black box. It's all right there. It's clear that you can see it. All integrated with the institutional grade custody that institutions have come to know and love from Anchorage. And then a flexibility of a set of options that you can come through, whether you're going through our institutional self-custody, going through Anchorage Digital Bank, you have the flexibility to use that. So I think the transparency, institutional grade custody, and the flexibility here really is kind of what I think is going to emerge as the standard, and we have achieved it here with this integration.
Yeah, Nathan, I know you've also said that, the Bitcoin market remains largely untapped in institutional portfolios, which I agree with. There's a lot of room to grow there. But then, many institutions have been hesitant to borrow against Bitcoin because of the argued volatility, regulatory concerns, infrastructure, etc. So how does this kind of deal with or address those barriers? And what do you think really kind of makes this new or different this time around?
Yeah, so I think there's a lot there. First, I'd say when you're thinking about borrowing against Bitcoin, you want to be careful to think about volatility, just like you talked about. I think Matt and team have done an excellent job thinking about duration risk, lockup periods, and how to think through managing the volatility. So I'll maybe let Matt speak to that, but after you pass through the volatility threshold, thinking about that, people want to be regulated. They want to satisfy their regulators in the way that they do this. And so holding within a qualified custodian, holding within a national bank helps them be able to meet their obligations about being able to do this safely. They want to be able to know that their team can actually operationally do this. So the infrastructure that's available to allow them to participate in the lending borrowing mechanism, and then just the overall maturity of the rails gets people there. Lending and borrowing have existed within crypto for a while. As Matt said, it's in a sense the native yield of Bitcoin, but there's still a practical consideration on, hey, how easy is it to actually do it? Can you safely participate there? And so that's what I'd say is volatility management through what they've done at Mezzo, and then regulatory and infrastructure, ease of use is all coming together nicely.
I think on the volatility side, we're dealing with a whole bunch of stakeholders that are different than in past cycles. So a lot of the time, if you look at borrowing and lending in the Bitcoin space, it's because folks are trying to short, they want to take leverage, they want to earn yield, but it's about pushing numbers higher. And these people live off volatility. So there are some participants that actually they want to go risk on, they want volatility, and they view lending and borrowing as leverage in the sense of just really levering up and increasing risk. What we're trying to ship is something, what we have shipped is something that's more appropriate for more conservative risk profiles. Mm-hmm. So, on the retail side, that's someone like me who my kids live in that house. I don't, that's right. The Bitcoin price really shouldn't impact the roof over their heads on the one hand. And then on the other hand, you have just large funds that want some exposure to BTC, but maybe they want to be a little bit more capital efficient. So that's really what we've focused on is, okay, instead of fixed term, we have opportunities for open term, we have lower interest, and then really the whole system is focused on higher collateralization ratios. So it's focused on safer loans. So that's how we've been approaching this. I think there's a hole because I don't think that everyone wants to borrow and lend to day trade. In fact, I think that a lot of these big players are just looking for better managing their portfolios.
Yeah, I mean, I wanted to ask you on that, Matt, too. So it's honestly a good follow-up is like, how do you kind of think about yield versus lockup duration and how that will play out for institutions? Like, are you expecting most of the users to lock up long-term or they want like a short-term flexibility on that front?
When we built our Bitcoin staking, which is actually launching later this week, it was really important to me to think about what Bitcoin holders wanted, because you look at a lot of the crypto space and they're okay with like long lockups for very high risk, frankly, yield. And what we're looking for is like, well, I don't think Bitcoin holders, it's one of the most liquid assets in the world. So let's preserve that. So that's why we stuck with, Bitcoin stakers with a 30-day max lock rather than like a year or something like that. I think that as large holders get more and more comfortable with systems like this, they're going to inevitably want to lock longer and get better yields that way. But at the beginning, we want to start light. And then I think on the lending side, the coolest thing is that in this system, you can actually stake and then borrow against your position. So I think that's where people start to get really excited because, sophisticated players understand, okay, borrowing means that I can borrow and then I can take that money and use it in a strategy. But either folks who are more conservative or less sophisticated, often they just want capital efficiency. So that's the idea is that we can give that in a way that's safe and not so high risk.
I guess, how does Mezzo then manage collateral margin or stress testing when it kind of comes to, institutions that borrow against Bitcoin, especially if, Bitcoin's price swings heavily? You're joking before, like your kids live in your house, right? So like you want to have that security, and I'm sure these institutions feel similarly, right?
Yeah. So it's this balance, right, between there's the socialized risk, and then there's like obviously you want people to be able to express their own risk preferences, right? For us, it's like okay, 150, to really that number changes a little bit as a min starting collateral is what we're pushing. If people want to go a little bit more dangerous than that, it's very clear that, well, you're exposing yourself to risk. Like you really shouldn't be trying to take 120% BTC to USD, So a lot of it is about guidance and education. And then on our team side, heavy back testing, right? Because all of this stuff is on chain. Thankfully, while some of these tools are newer to Bitcoin, they're not new to DeFi. Right. So we've seen this stack work since 2020. It's gone through multiple, choose every day of the week. And we've had a black that in crypto. And now we have a DeFi stack that's nothing's bulletproof, but it's very strong. So I think that's how I look at it. And then the other way is just, the whole point of the crypto space is to take custody, to take risk management, to take your life into your own hands. And as an institution, you have to follow the rules of your regulators, but that doesn't mean you shouldn't be taking this into your own hands and having a position. So that's kind of how I look at it.
Man, I think probably worth kind of like adding there how well, relatively speaking, historically, the DeFi lending protocols have done. When you like kind of look at the landscape here, if you think about some of the issues that we've had, most of it's been in centralized, non-automated systems, where
that's a very good point.
Underwriting discipline lapses or some other thing kind of lapses, and then you end up with blowups. Whereas DeFi, transparent DeFi, has performed incredibly well through basically all of the crypto cycles.
A great point. If you look at, for example, Celsius or Genesis or these blowups we've had in the past. Sunshine is the best disinfectant, right? And the problem with this was there's all this lingering leverage that no one knows about. So what's great about these systems is there's nowhere you can hide. An institution can come in and it's like, well, you can point to every obligation and be confident. And that's not something that can happen in centralized finance. That's why trust companies exist. It's incredibly difficult to say, I'm sure this is completely unencumbered. So yeah, a different way of looking at this from like a traditional finance lens is the counterparty risk is totally different because, you can't play around with people's funds. The smart contracts won't let you. So, if you look at honestly, the market kind of answers this the best. Since Genesis, DeFi lending has grown 900% just with Bitcoin on chain.
Wow.
So we're seeing that instead of CeFi filling the role with new loan desk, we're actually seeing this explosion of on-chain liquidity.
So do you feel like it has kind of recovered from those Celsius era days?
I think that people are still holding back. It's tough to be a Bitcoin holder and an early adopter, right? Because a lot of the time people don't want to do the work and they'll cheat and they'll use the centralized, finance tool when they really shouldn't. Versus if you're using Ethereum and Solana, people kind of have a different expectation of how these things work. So I think a lot of people who got burned in the past are getting ready and itching to come back in, and I'm expecting a lot more growth from here.
Yeah, I was just gonna say I think one way to think about that question is like, are we coming back? I would maybe counterintuitively say no, we're not coming back. And what's happening is that we're actually just becoming normal.
Yes.
And what is normal in the financial markets is 24/7 repo markets, stock lending, collateralization against stocks, bonds, and equities in order to get leverage. All of that is totally normal, happens all day, every day. And so maybe the historical version of this in crypto was kind of like the training wheels era. Or guess what? Some bikes didn't do so well in those training areas, but now we're kind of like building it in a mature way.
Mm-hmm.
And so it's almost like we're kind of graduating into what it ought to be. And so I think it's like it's coming back. What's coming back into like we're like graduating into a different version of the way we think about this.
I mean, really, we should be able to do everything you can do with securities, everything you can do with commodities, with additional assurances. Right, because we have code that is running without a counterparty at all times, and that's something that's new to the world.
I guess what would that graduation, so to speak, unlock in the near term and long term? Now that we're in this like new era, I would say.
So my big thesis for where we're going with Bitcoin lending is, if you look at Bitcoin, the story since maybe 2016, 2017 has been we're going after gold. But I'm like, well, that's not enough. Anything with a monetary premium in our lives, like anything where it's like, oh yeah, this is a good investment. Your parents told you, oh, we've done this for generations. Those are things that the monetary premium is going to be stripped by Bitcoin. So kind of how I see this going is, okay, we're eating gold. We're making some pretty serious progress there. What's next? And I think real estate's next. A lot of people probably wouldn't believe it. They wouldn't believe it when you say, well, Bitcoin could fix housing prices. And then in the end game, they won't believe it when you can say, well, Bitcoin means a world with less war. But when you make kind of like Bitcoin the obvious choice to invest, you no longer need to buy a third home. You no longer need to, unless you want, I mean, just for your use, but not to rent it out, not to do all this other stuff because you're looking for a safe investment. And similarly, central banks, as they get squeezed and squeezed and squeezed more, well, that's a counter to profligate spending, to, frankly, to starting wars and printing. So ultimately, I think that's where we're going. Gold is just another thing that we're stepping over, and next is monetary premium on real estate.
Nathan, you agree with that?
Totally agree with that. I think there's a bunch of dimensions I can dig into there. I mean, maybe one that I could specifically talk about is people want to say, hey, you should hodl your Bitcoin. You should like hold on to this asset. We already do that with real estate. That is like the one asset in America where people decide to buy something and their time horizon on that investment is measured in decades. And so what we're doing here is allowing Bitcoin to get the same kind of natural time horizon and time preference that you're already establishing with real estate. And I think like that unlock is kind of the first step here. And then particularly for institutions being able to do that as well, you say, hey, like I don't have to exit this position anymore in order to be able to monetize it. That unlocks a whole set of opportunities that are available. Yeah. And then the natural consequences that are exactly what Matt laid out. Fundamentally more sound money once we kind of see all the dominoes fall. But this is kind of one of those early dominoes that really helps set off what we hope happens there.
Bitcoin becomes the forever asset.
How do you kind of, not convince, but like educate people on this, right? Because if you went up to a stranger on the street and said this to them, they
Yeah.
probably would think you're a bit crazy, right? But like, I understand what you guys are saying. Yeah.
Yeah, it's crazy. It's crazy uncle territory. So it's funny. I had to learn pretty early in my Bitcoin career to keep this stuff to myself, right? Because yeah, you're talking to someone. I mean, back in the days where I was like literally getting debanked, like okay, telling someone, well, we're approaching a new world order in 20 or 30 years or whatever. That's not pragmatic, right? But I think, the way I've convinced myself, before I talk about how I convince my family and my friends and my coworkers, is that all of these things that I thought were insane, like I never thought that I would see, deeply. I told myself I would see, oh yeah, presidents will care and nation states will care about Bitcoin. But now this is something that the Overton Windows move, we're talking about it.
It's a reality.
Yeah, the IMF has to respond to it. Like this is not something that people get to ignore. So on the one hand, it sounds crazy, but then if you just look at the headlines over the last 10 years, it's like, okay, I'm seeing some momentum, and this isn't crazy. So I think what I do instead is I try to just talk about analogies. Hey, maybe you can't, own a rental property. Maybe it's like outside, but you can own a little bit of Bitcoin. That's something that you can do right now. You can do it from your computer, and it's really just about having a long time horizon. So I kind of try to use analogy, to help people understand, because it's like you don't have to believe that Bitcoin's going to take over the world for it to take over the world.
For me, maybe the one thing I'm thinking is like, I can't live in Bitcoin. I could live in a house. And I don't own a house either right now,
Yeah,
because I actually
sure.
don't see it as like a really great return on investment. That's
Of
why I
course.
haven't bought in a house.
The short answer is like, actually, you're perfect for this, right?
Yeah, yeah.
Because, if you feel good about Bitcoin as investment, but not a house, the most sane thing to do is to borrow against your Bitcoin because it's going to go up, and to buy a house. That's perfect. It's almost an infinite money glitch for you as long as you believe in, Bitcoin going up.
What happens when it doesn't go up though?
Yeah, that's where you have to have really conservative risk management.
There's that reality.
I haven't experienced. Yeah. Oh, of course.
Yeah.
I mean, I think what we're doing, is we are giving people the tools to live the life of Elon Musk, right? Which is he has this Tesla stock, and he never sells it, and he borrows, and he can fund his life and move on, and that means he gets good tax treatment. That means he can really just like have the life he wants without the downsides of selling that he'd have, right? So we're taking this tool that's really for high net worth people, and we're trying to make it democratic for folks who want to afford homes, but we're also trying to make it accessible for large institutions because just the tech hasn't quite been there in the past for Bitcoin. So I think in the case of institutions, they have the tools to do their risk management. I think in the case of individuals, people just need guidance. They need to understand, like, and honestly, considering how complex a mortgage is in the U.S. and that it's such a common financial instrument, I think people can get comfortable with some of these ideas pretty quickly.
Do you think the behavior for institutions has shifted substantially over the past quarters?
Yeah, I think so. I mean, I think I actually talked to Matt about this early on as we started thinking about how to potentially start working together on this. One of my really interesting lessons from working with institutions was ignoring Bitcoin for a moment, talk about that other asset, Ethereum. It took us a lot of work actually, to get our clients to stake their Ethereum.
Why is that?
Okay, so these are like long-term ETH holders, and just the idea of like, oh, instead of just holding it, I'm going to participate in staking for this asset. There's a tremendous amount of effort to put into getting them through the diligence process, getting through understanding what needed to happen there. And so when you think about okay, what's the intellectual leap I need to make here in order to say, hey, I want to borrow against my Bitcoin, I want to do that on chain, I want to participate. Just a whole host of activities that they need to diligence, things that need to go through, and so we really built this to be a thing that could get through those diligence processes as they start to look at it. I think particularly with the digital asset treasuries coming back online with the SEC opening, we're going to see a lot of potential energy there around, hey, what do we do productively with the Bitcoin that we're holding in the treasury? If the big ones are just going to maybe sit on it, then I think there'll be a whole host that are going to decide, hey, I want to go in this direction, or I want to go in this direction. They're going to be looking for that native yield that is available within the Bitcoin ecosystem. And so I think that's a early indication of what's to come there, is that we'll start to see some of this go probably into the digital asset treasury companies. And then I imagine over time we will see perhaps even ETFs that utilize some of the mechanisms that Matt and team have built to increase the yield on Bitcoin in those kinds of wrapped structures as well. So I think that's probably where we see things going over time.
Yeah, yeah, I think that's right. Definitely, the DATs are moving first. The other thing that's kind of interesting, and I won't claim that I know how this is going to play out, is, this cycle has made a lot of OG crypto people have to pay attention to traditional finance. It's like traditional finance is being made to pay attention to Bitcoin, but it's happening both ways. So one of the things that I've learned watching Strategy and watching Sailor is, you are going after entirely different classes of investors. This is a fixed income investor over here, and you have an asset for that. So I think, I kind of view our job as helping those people go from maybe a fixed income investor investing in some strategy product to doing something on chain. So I think on the one hand, we have DATs are moving first. I think eventually we'll see ETFs move as well. But I also think that we're going to see entirely different classes of investors start to get interested in our space with these tools.
I guess one of my last major questions for both of you is on this frontier of Bitcoin finance, as it continues to grow, how quickly do you expect this adoption to scale? And then if you look years down the line, what does success really look like on this front? Both for like the partnership that you guys launched last month, and then, the overall sector of Bitcoin finance.
Well, I think that success really here, going back to what I said earlier, success is people aren't thinking of TradFi versus BTC5 versus DeFi. They're just thinking of this as the natural set of tools that are available in the ecosystem. And it's all just finance, much in the way that like companies, there's no such thing as an internet company anymore. That's just called a company. And there's no such thing as crypto finance. It is just finance. And so how does this happen? I think things get integrated. Things feel very natural. This is an option available within a menu of options, and it feels very natural, and actually maybe is better than any of the other traditional tools because of the level of transparency, the level of automation, the level of removal of counterparty judgment that needs to go into it. And so that's where I would think of the frontier eventually becomes tamed, if you will. So that's probably the way that I would think about it, is the frontier becomes civilized.
It becomes normal. Yeah. So we like to talk about, because we have a pretty serious design DNA at the company, this idea of super normal. And it's like, okay, not only is something not going to lead to raised eyebrows at like the Thanksgiving table or something, right? That's like one hurdle where we're still not quite across it. But, you think about your favorite pair of shoes. Bitcoin should be your favorite pair of shoes. It shouldn't be a thing that needs, everything needs to say Bitcoin in front of it for people to understand. So on the one side, that's finance is finance. On the other, that's, just your everyday life can be funded by Bitcoin. It doesn't need to be like a big orange thing in your face all the time. So I'm really excited. I mean, I'm excited to solve it first for institutions because that's what we have to do. There's so much capital that's ready. But I think what that's going to lead to is, an entirely new set of neobanks. We're seeing the beginning of that right now.
And aside from everything that we talked about today, you guys obviously do a lot across the space. So I want to ask, what is something that you're watching right now that you think others should pay attention to?
So some things that I'm paying attention to. Well, as an engineer who has found himself deep in finance, um, I'm paying a lot of attention to what Bitcoin treasury companies are doing. I'm expecting a little bit more consolidation. I'm expecting that, we had a lot of kind of unsophisticated people start these treasury companies, and now they're realizing like, oh, we actually need to know how to earn yield, how to borrow. So I'm really watching carefully, like as people figure out these lessons, and then as some of them who can't figure out these lessons sell, right, and sell to either more determined holders or really to better operators on the yield side. So I'm paying a lot of attention to that. And I would say the other thing I'm watching carefully is all the tech is there for us to sort of leapfrog on the user experience side. So like anytime someone shows me an application where people don't think it's a Bitcoin app, they don't think it's a crypto app, it's just an app, I get really excited too. So that's kind of my barbell is, what's the big money doing on Wall Street, and then where do people not even know that they're using Bitcoin?
Yeah, I mean, I think it's not terribly surprising that most people right now are thinking about how do we think about AI and how do we think about crypto. So that's something we're doing a lot with AI, mostly just like internally with Anchorage to optimize our processes. But I think it is going to be interesting to see like what happens once AI becomes more autonomous, if you will, and what are the things there? Are they even going to pay each other? I don't know. Like I still don't even know if the AIs are going to be capitalist or they're going to be communist. And so it's like,
Yeah.
I think it's an interesting, like, first order question on whether the AIs are going to be paying each other or they're going to be interacting in some way. But I think it's worth paying attention to as we're looking at something that is going to be transformative for not just our industry but every industry. And where things end up there, I think is interesting to take a look at and follow pretty directly.
I think there'll be
If there's going to
capitalists.
be a machine economy, you think so? I mean, it's like everyone ends up being capitalist no matter what.
Yeah,
But if there's going to be if there's going to be a machine economy and they're all running in data centers, it makes sense to me that the money backed by power would be the thing they trade. We'll see.
All right, last thing. I always like for our guests to leave us with a piece of advice, something that you've carried with you throughout your time in this space.
I've got one for Bitcoiners. I think if you have been holding for a little while, congratulations. You haven't gotten hacked. You haven't gotten scammed. And that is because you have had a high bar and you've known that, 95% of what you see that people claim is going to be good for you isn't. The tech is ready, though, on the Bitcoin side, to actually do things and to not just keep your money under your mattress. So yeah, I would say I think it's a really good time to be optimistic. I think if you're looking, if you spend your time on Twitter, maybe you feel rough, but if you're a long-term holder, the promises we've all been talking about for years are happening right now, and you can be a part of that.
Love it. Nathan, what's your advice?
Yeah, I think riffing off of what Matt's saying is like the infinite vigilance here is wise for. Maybe on the other side, I'd say, hey, what Matt is speaking to is kind of like the long-term holders that have made it for a long time. That's, stick with it. For people that are coming in new, that are new to crypto, heed Matt's advice. Be very thoughtful about what you work with. Be very thoughtful about what kind of tools you decide to use. Do your diligence. Understand that the people that have come before have probably done a lot of that diligence, and that's it's just really important to get some of that stuff right. So that'd be my first thing, and then the other thing I'd say is just that the future is infinite. There's a lot of incredible stuff that can get built, that can be shaped, and so the core driving force ought to be optimism, because I think there's a lot of really, really interesting stuff, really a lot of really interesting opportunity. And so stay vigilant, but also stay optimistic.
I love it. I'm an optimist too, so I feel that. Amazing. Matt, Nathan, thank you so much for coming on, guys.
Thanks for having us.
Thanks for having us.